Hello, ladies and gentlemen, and welcome to our interview with Hugh Shannon. Hugh is a director of growth and operations at OakNorth. And OakNorth is a fintech bank that focuses on making loans to small to medium-sized businesses in the UK and around the world. And in addition to that, it also created a lending technology or platform as a service solution for other financial institutions that delivers credit decisions up to 10 times faster than traditional models. Hugh, thank you for coming to our interview today.
Thank you for having me, Boris. Excited to be here.
Absolutely. It's my pleasure. Hugh, can you tell us tell us a short story about your career path and what brought you to where you are right now and what you guys at OakNorth are up to these days?
Sure, Boris, happy to. So I started my career, I studied commerce and law at university and started working as a lawyer for banks as a client base, but quickly moved into investment banking, again, covering financial services and banks. And, this was back 2006, pre-financial crisis. I was working in Sydney and, very soon and sort of a very formative experience for me work, in the professional services space was the financial crisis and had a pretty significant impact on banks in Australia as well, much more from a funding perspective, probably than from a credit quality perspective. But look, what I really loved at the time and continue to love is sort of that intersection of, finance, commerce, but also with that regulatory overlay, right? Like the complexities that brings in, regulated financial services and in banks in particular. Fast forward a couple of years, I got married. My wife and I actually came to New York, where I live now, on a honeymoon from Australia. It was springtime, the blossoms are out. We loved it so much. We're like,
yeah,
great.
Cherry blossoms, yeah.
So one thing led to another. Basically, we've lived in New York ever since then. The first, 9 years in New York, I continued to work in investment banking, focused on financial services with a big focus on banks, but also covering off on fintech. But what was clear is, when I would go and talk to our bank clients and CEOs and boards and strategy team, yes, they're interested in M&A, but they're also really interested in technology, right? And how does that actually help to transform, their bank? And so I had the opportunity and met some of the folks at OakNorth, and I'm like, look, this could actually be a really great opportunity for me personally, in that builds upon my expertise and relationships and networks in financial services and banks in particular, but also has that real emphasis on technology and how can technology be deployed and how can banks use technology to better work and service their clients in commercial credit, commercial lending in particular. So that's the sort of the quick recap of what's brought me here. So happily living here in New York with my wife, and have now got 4 kids. So we're well embedded and loving every minute of it.
All right. Okay. Interesting. So the company is UK based. You're Australian working in New York. Very good. Yeah. All continents almost.
Yeah,
another two, and you are done. Okay, so can you tell us a little bit about OakNorth? What is your business model? I know it's kind of fintech bank. It's kind of lending for small companies. Maybe you also have a platform or service. So maybe you can tell us a little bit more. What is it all about? And how you're different from your competition? So what you make your kind of core business living and competitive?
Yeah, sure, Boris. Happy to. So yeah, look, OakNorth. We were founded, as you mentioned, 6 years or so ago, by our founders Rishi and Joel, and they themselves, are entrepreneurs. They'd built previously a very successful business in credit research, but in the formative years of growing that previous business, they found it very difficult to go to traditional Main Street or high street banks and get access to credit, right? And, it was, because basically the approach that banks take to, commercial lending, very backward looking, you're looking at historical financials, they don't think about like where those businesses are going in the future. And, it was a very sort of challenging time for them. Ultimately, they got access to the credit through one of their clients, the special situations desk, so sort of tapping more into that corporate institutional arm of banks for lending. And so they saw sort of that difference between the more bespoke approach that a corporate institutional desk can take versus the more sort of check the box approach for commercial lending, right? So with that sort of formative experience, when they sold their business to Moody's in 2014, they said, look, is this a common challenge for other entrepreneurs? And quickly they found that yes, it was, right? That entrepreneurs, growing businesses, they're often not able to tap the credit that they need to support their businesses, from Main Street banks. So they thought, well, look, we've got a background in credit research. We know how banks approach it from an institutional level. Can we actually bring that approach together, use data and analytics and technology to sort of help automate some of those processes so we can get the insights and get that bespoke nature to lending, but without the massive cost and time overhead that you take in that corporate institutional space, right? So actually make it economical to take that approach in the commercial lending sphere. So to do that, they started off by founding OakNorth Bank in the UK. At the time, it was only the third new banking license issued in the UK in over 150 years. Obviously, there's been a number of challenger banks that have emerged, subsequently. But OakNorth Bank, has continued and it's really thrived, and it's focused purely on lending to entrepreneurs, cash flow lending, and also lending against commercial real estate. But the bank has now, over the 6 years of history, lent more than $8 billion US equivalent, and done so in a very profitable and efficient fashion, right? So it has a return on equity of close to 30%, an efficiency ratio or cost to income ratio of 23-24%. And cumulatively over our history, we've only had 10 defaults, right? Which, is pretty strong performance, right? And, it's really built upon taking that data-driven, tech-led approach, but also taking a forward-looking approach to where, credits are going as opposed to where they've been, right? So out of that experience and the technology that we've developed within the bank, we've then commercialized that technology, which is now, what we call our OakNorth Credit Intelligence Suite, which is the arm of the business that I sit in here in the US. And so we work with banks as partners in the US to license our technology to them so that they can take, that same data-driven, forward-looking view for commercial lending and ultimately get outcomes of, faster lending, more efficient lending, better credit outcomes, and overall, more profitability in the commercial lending space. So that's, Boris, a sort of quick overview of, how the different pieces fit together. So you've got the bank in the UK, you've got the technology business, software business, separate from that. But I think just one final point is, as we go and talk to banks and, sell our product out there, the fact that we have our own bank, that we've put our own capital at risk in applying our technology and approach is a real differentiator, right? Like, we're not just a technology company that's, written up some code and sort of deploying it like, look, hey, here's an approach you should take. Like, we're actually practicing what we preach. And so banks appreciate that. And then also the insights we ourselves get from actually running and operating a bank really inform our approach as well as we build out that software and offering for our clients.
Fantastic. Maybe can you give us some examples? Maybe if you don't want to throw names, just what is something you or your team have recently achieved that you are really proud of? Maybe some business case that you solve for your customer, just to understand in practical terms what you guys do.
Yeah, sure. So no, look, happy to sort of give some specifics there. So, we've got a strong client base in the US and growing. We now have, over $365 billion of commercial loans that are running through our software platform that we're analyzing, on behalf of our clients. Just recently, an existing client, which is Fifth Third Bank, which is a top 10 bank by asset size or commercial lending in the US. We've expanded our relationship with them to include our climate impact framework. So if you think about, what I was explaining before, which is, we use our software to provide banks with a forward-looking view of risk. Obviously, climate risk in banking and in commercial banking, is an area of increasing importance for all stakeholders, right? But obviously driven hand in hand by regulators and boards, right? And so for Fifth Third, they themselves are a very forward-thinking bank, amongst their US peers around how they want to address ESG matters in general, but also climate risk specifically. And how we are working with them with our software is actually, if you think about, some of the industry standard climate scenarios, so NGFS or IPCC, for example, there's very well defined climate scenarios that the industry is sort of coalescing around. But the challenge for banks is how do they take those scenarios and then actually apply them down into their loan book at a portfolio level, but then even more specifically at the individual borrower level. So we have developed multiple, individual subsector scenarios, taking those industry standard scenarios, bringing them down to a specific subsector, which can then through our software be, applied effectively at the push of a button against individual borrowers and come up with a climate risk score. So, Fifth Third are really excited to be working with that as we help them develop their ability to run climate risk scenarios. And then also as they think about, the future of metrics and data for climate risk. So that's one that we're, really, excited about, and personally as well, because, the sort of size, sophistication of that client, it's an existing client expanding into this new area that we're offering. And, certainly, and I'm sure, Boris, you and your, members and listeners have seen, climate risk is an increasing area of focus, for obvious and necessary reasons.
Yeah, absolutely. ESG is very popular right now in all floors and discussions, topics on our community, right? And now again, specifically, it's kind of all the credit risk, and still you're talking about climate risk. So maybe I would like to ask you a personal opinion. What is the commonly held belief or misconception as it relates to credit risk that you are strongly disagree with?
Oh, wow, that's a great question. So, look, I think one, personally, and then I think it's held, by a number of us here, at OakNorth, and sort of drives our mission is, is that backward-looking, historically based models versus forward-looking, right? So, I think with good reason, a lot of credit risk, is necessarily built upon models and dual risk rating models, etc., right? But by their nature, they're obviously informed by historical experiences and historical credit cycles. I think, our view is, there is a better, personally, the view is, look, there is a better way to think about that and approach it, right? Which is, incorporating in a far more dynamic, forward-looking, mechanism, right? And I think banks, you know, the experience that they've seen, you know, if you think about COVID over the last couple of years, I mean, banks say, well, look, you know, we kind of did that, right? We achieved that through COVID. When you actually drill in and understand what they did, for a number of them, it was taking an existing framework, going through a very, you know, manual, bottom-up, subjective process in terms of, you know, inputting adjusted figures, and applying a very subjective overlay to come up with, you know, adjustments to risk ratings and the likes. You know, I think the view from many is, look, you know, we got through COVID okay, and, you know, potentially we can just apply the same approach going forward. And, you know, personally, you know, I think maybe we learnt some of the wrong lessons from COVID, particularly in the US, and, you know, I think in other markets as well, just given the level of government stimulus. You know, we all largely avoided, you know, credit disaster, right? But I think because of that, people sort of learned the wrong lessons, which is, well, look, you know, the approach we took kind of works, whereas the reality is, you know, the next big black swan event in credit is going to be different, right? You're not going to be able to just apply the COVID playbook again. And, you know, who's to say that there will be government stimulus again? Who's to say that government stimulus will work in a different sort of scenario? So, you know, banks do need to, I think, take a bit more of a fundamental approach to how they think about, you know, analyzing these sorts of, you know, scenarios and adapting to them going forward. Does that sort of answer your question, Boris? And, you know,
yeah, I think it's very interesting. Specifically, you touched the point of pandemic and risk. So I thought you mentioned that only, what was it, 10 defaults were. So it maybe also underlines why it was so little defaults, even in this very tough period when we kind of expecting a lot of defaults and for small businesses, right?
Yeah, no, and look, that's right. And, you know, if you talk to our team in the bank, you know, the analysis they were doing very early on in the pandemic, you know, even in, you know, January, February 2020, when it was far more of a localized, you know, it was thought to be far more of a localized supply chain type issue, right? And then it quickly evolved from there. But because we embed that forward-looking view into the core of, you know, how we run the bank and run credit analysis, when you then need to incorporate new fact patterns or scenarios like an emerging pandemic, yes, you need to think like, what is that scenario? Like, what is that scenario and how should we sort of model it out? But then to actually apply it across the portfolio and understand the impacts, you can do it very quickly, right? So what in the bank they were able to do is quickly understand and drill into, you know, for example, hospitality. And, you know, we have and continue to have a pretty decent sized hospitality component in the bank's book, but they were able to very quickly drill in and understand where potentially is the most vulnerability. How can we get ahead of that and, you know, not wait until we actually see, you know, missed payments or the like, but actually be more proactive on that front.
Okay, fantastic. So if we summarize it, if someone who is listening to this interview would like to walk away with one or two major takeaways, what would that be?
Yeah, great question, Boris. I think a couple of things. So one is, you know, we find working with all of our banks, if this is the case, is even before you think about, you know, this future of credit, or, you know, as we call it at OakNorth, credit intelligence, a large part of it is getting your hands around the data that the banks have today on their customers, right? And how do they manage that and actually allow them to interrogate and analyze that data, right? So I didn't really touch on this earlier, it gets a little bit technical, but you know, just one example would be, you know, for banks, you're obviously storing information on your borrowers and their loans in your core banking data and core banking system, but you're also capturing their historical financials in your spreading system, right, that you use for purposes of underwriting. For many banks, they don't have a good relationship or database that maps between the two in a consistent fashion, right? And again, you think about that historical approach to underwriting and portfolio management, like that's not been a real impediment. But then if you think about what I've been talking about with, integrating forward-looking analysis, at the core of how you think about your borrowers, you actually do need to have a very good mapping and understanding how that works. So there's a lot that banks can start to do, in terms of getting their data in better shape. And, a lot of the clients we work with, that's a great initial first step that we do. I think then the second part would be, again, thinking about, how start to think about, is there an approach which is a more dynamic approach to credit policy, right? In that the way that a number of banks approach change in outlook for industries or sectors is very much driven by, their own experience, but also then informed by effectively, the credit culture of the bank, right? In terms of, knowing like where things sort of shift, right? Again, I think where, we have success with clients is, not necessarily ones that are saying, look, let's deploy this today, but they view the potential for saying, well, look, if we actually have a stronger view of the sectors that we lend into, a view of where they're going, we can run dynamic scenarios across and understand like what the impact is for that sector and borrowers. We can actually start to think, look, can we set credit policy in a more dynamic fashion? And then that, helps obviously better credit outcomes for your portfolio. But then where it starts to get really interesting is that it actually allows on the origination side, a far better focus and pursuit of opportunities. You think about trading off that risk and return. So those would be the couple of things. So I guess, summarize it down, which is getting your existing data in order. Many banks are focused on that, but, we at OakNorth, as we work with banks, we see that we're a great application to get something actually out of that project. And then the second piece would be, as you start to think about the potential and the opportunities, again, it's not just limited to, look, is there potentially some little marginal efficiency gain or marginal improvement in credit, but it actually has a far bigger impact around, how, you're setting and running credit policy and, the impacts across the bank.
Right. Okay, fantastic. So I asked this question, all my guests, because I'm running global risk community. We are a community of risk managers, about a total 100,000 people on our community and our list. So how, from your point of view, how can we better contribute to this, to understanding of this complex world of risk?
Look, I think it's, what we've seen as, on sort of a much smaller scale as being successful is, I think it's a subset of what you're doing, right? Which is bring together peers and like-minded individuals to share their experience and best practice. And one thing that we've started doing recently, on the climate risk front is, bringing together groups, not just to share information, but also, to sort of share, best practices and how they're, focused on it. So, what we've found works well is, bringing that, little consortium group together, and even virtually it works quite well because you can bring a group together, but then have little breakouts and, focus on key questions and sort of report back to the group. And, I think what we've found is if you get, you've got to be somewhat niche, right? Focusing on people in one area, but, people are, more than happy to sort of share information and, it leads to some good sort of momentum, in that particular topic area.
Okay, fantastic. Great idea. Thank you. It's climate risk specific we didn't discuss. We discussed some ESG topics, but maybe climate risk we will have to do sometimes in the future. All right. So thank you, Hugh, for your time and for your interview. And I wish you and your company, OakNorth, great success, both in the banking and the software business, and look forward to hearing from you in the future.
Great. Thanks, Boris. It's been a pleasure.
Absolutely.